Well, good day, everyone. I'm Dr. David Phelps. I'm the founder and CEO of the Freedom Founders Community. This is Real Wealth Week. What is wealth? Why do we want wealth? What's wealth do for us? How do we define what wealth is? For me, wealth has been about giving me freedom, giving me options in life. Wealth that provides for the sustenance of my family, my lifestyle that I've determined without me necessarily having to be involved in daily operations. Not that I don't love what I do today, but having the opportunity to have more flexibility in my life, to be able to pivot, to have more stress-free, more peace of mind in the uncertainty and the volatility that we are certainly seeing in the marketplace today. Financial independence is the base to me of all the other freedoms in life. Time freedom being a big one. How much discretionary time do I have in my life? This week, I've brought together some of my longest colleagues, cohorts, friends, through whom I've met through other groups, other masterminds. The relationships that I've built through many years has really become my best insurance policy. We're going to talk a little bit about insurance policies, and what might be part and parcel for you with my first guest today. But laying the big picture, we're going to stay conceptual, give you some big picture, give you some strategies, and then the opportunity to do a deeper dive in some of the areas that you find most relevant to you. My first guest today, I'm pleased to have Mr. Chris Miles of Money Ripples. Chris, thanks for being with us today.
It's always a pleasure to be here, David.
So, Chris, as we kind of look at the macro, the big picture, you have been through cycles. Probably the last big cycle was the 2008 GFC. What lessons or scar tissue do you have, just to give from a big picture, from obviously an entrepreneur, a business owner, a husband, a father? What lessons have you learned that might be provincial for us today on a big picture?
I would say this. It's kind of like what my new book is centered around, is these three concepts of get lean, get liquid, and get out, right? I mean, especially before hard times. And we know, I mean, if you don't feel it already, we all feel it, that there's something coming. There's something brewing, and it's been getting bigger and bigger. Like, we've been in this big bubble. Something's coming up, right? And if you're not prepared, you're going to be the one that's actually suffering through this and have to delay years and years of financial freedom because you're not prepared for what's coming right now. So get lean, get liquid, get out means this. Get lean means be a wise steward of your money. Track your money at least on a weekly basis, both in your practice and at home, right? Make sure you're doing that. Make sure you're a wise steward in the sense of looking. It doesn't mean you just live on rice and beans. It doesn't mean you cut out that latte necessarily, but it does mean really prioritizing where do you want to spend your money, and also where's their cash. That's one thing I think a lot of people, especially in the dental space, right? A lot of times we just kind of get a little bit lazy, especially in good times, and we tend to just take our eye off the prize. And we need to be diligent. We need to make sure we're profitable in our practice and also profitable at home. And get liquid means that we got to make sure we have liquid cash available. Isn't it ironic? And I know, because I'm a recovering financial advisor. I used to be a financial advisor over 20 years ago. And everything that I taught as a financial advisor that I would teach to you as well back then was that you needed to lock your money away into prison, right? In those 401ks and those IRAs, lock your money into that home equity. And then when you need it the most, you can't get to it because it's locked up in those places. And get liquid means having that money in cash on hand. It could be in a bank. It could be in other strategies, like we talk about infinite banking, things like that. But having that money liquid and available, ready to go, especially if we move into hard times, because during hard times, the one thing that the person that always wins is the person with the cash. Just like in the Great Depression, right? Joseph Kennedy, John F. Kennedy's dad, he was worth $4 million in 1929, but because he had liquid cash available, he was able to take that, buy a bunch of commercial real estate. It was worth over $100 million by 1935, just buying up Manhattan, right? He was the Trump before Trump, So really, you want to make sure you're liquid with cash and have it ready to go. And that's how you get it out, right? We get it out to not just locking away in prison, but get into cash flowing investments, which I know, David, you talk about all the time. And just like my t-shirt says, I love passive income, right? I mean, you want to make sure you have that passive income, those real tangible assets are actually paying you on a regular basis.
Well, Chris, you said something that I think is common sense, but not always common practice. And you talked about being a good steward of one's money. I think everybody wants to be a good steward of all their assets in life, whatever those may be. The problem is that we have grown up in a culture, a society, with Wall Street being a major marketing engine that it is. And you mentioned the construct of locking your money up in the 401ks where it's safe and it's disciplined and you get the tax benefits and, it's going to be there and for your retirement. But we know that even though I'm not against, I will say I'm not against some liquidity there, but I think you and I come from the same page in that we prefer assets that we have more control over. So coming back to being a good steward of one's money, there's a lot of passivity about that. People think they're being a good steward because they, open a brokerage account with Merrill Lynch or Schwab or Fidelity or wherever. They think that's being a good steward of their money. Talk a little bit about that because you came from that area. You mentioned a minute ago that you used to be a quote financial advisor. Give us some differentiation there in terms of how you help people become better stewards of their money, taking the responsibility to be more in the forefront of that very thing for themselves.
Well, you hit the nail on the head right there, David. It was that you cannot ever have freedom without responsibility. I mean, even our founding fathers knew the same thing when they set up this country. Is they knew they had to take personal accountability and responsibility in order to have real independence and freedom. Financial freedom and independence is no different. You got to take that personal responsibility. And it doesn't mean that you don't leverage, people in your life. Like you mentioned, David, like when you came on, you have your own mastermind, your own brain trust that you use too, and we all do, especially those of us that have been around a long time. We know we have to be surrounded by the right voice and the right people. Unfortunately, in the financial advisor game, you're not so much paid to make your clients more money. You're paid to sell them crap, to put it bluntly. And that's the problem, right? Because, for example, to a hammer, everything looks like a nail. When I was licensed in securities and insurances and things like that, I was legally told I could only offer those things. So mutual funds, that's what I could sell. I could offer you that. Annuities, things like that, whether it's variable or indexed or fixed or whatever it might be, insurances, that's all I could do. That was everything I was able to do. And in fact, even in the financial world, they tell you it's suitable. Give them those suitable products. But the problem is, even if I saw something was better, like in real estate, for example, I couldn't even recommend it. I couldn't offer it legally because my licenses restricted me from doing that. And that's the one thing you got to understand is that really I was a salesman in a suit, and so is everybody else. As good-hearted as financial advisors are, they of course have been really trained and brainwashed to believe that the only answer is Wall Street. Yet that's only been around for a few hundred years, but for thousands of years, Main Street investing, like investing in businesses and real estate and land and things like that, that's been going on for thousands of years. That's been the place where you see all the private equity firms, right? Especially the firms that are more doing family office style, where they have clients that are worth at least $25 million. That's where they're putting their money. They're putting it to Main Street investments, less in the Wall Street, especially right now, where right now the S&P 500 is more than double the actual real valuation of the S&P 500. We're literally in a massive, massive bubble. And if you don't catch it soon, you're going to be one of the victims. You're going to be one of those people that said, I wish I would pull my money out of the market, a couple years ago. I wish I didn't have to wait this 10-year, slow, recovery before I finally get my money back to breaking even where I was a decade ago. That's what happened in Y2K when I was a financial advisor, and then going into the Great Recession. People waited 15 years to get their money back to where they were in the year 2000. You don't want to be caught in that place. And so do not believe for one second that financial advisors, as good-hearted as they are, don't believe that they're going to offer the best advice, because their advice is restricted to a very myopic view.
You mentioned also the need for people to have more liquidity, particularly at a time like we have today where things are more uncertain, more volatility. Yet, Chris, it is so hard to think about not having our capital, our money invested somewhere where we've been used to in the last 5-10 years when figuratively money's been running uphill for a lot of reasons we're not going to get into today. We know what they are, but realizing that this bubble, and you're so correct, the bubble that has affected the financial markets, it's definitely affected real estate and different asset classes. There's a tipping point, there's a turning point, and we don't want to miss out on that. We think, whether it's crypto or real estate or NVIDIA, it's been on a tear and it keeps going up. And it's like people say, this time's different. I mean, the markets are going to get to all-time highs. It never happens that way. And it's the last people out that take the hit, because particularly in the efficiency, I say the efficiency of the financial markets, which you know very well, is things happen very quickly. Things can move up very quickly, and they can move just as fast or faster on the downslope. So talk a little bit about kind of FOMO. I'm missing out. Everybody else is doing it, and here I should be more prudent with my money and take more chips off the table, pull it back, and hold on to it. Oh, that's hard to do. How do you help with that, even in your own story, which I know you have lessons of scar tissue from going through major downturns and maybe things that you picked up that have created more discipline in your own life notwithstanding what you give to other people that you help.
Yeah, I'll tell you the first thing that woke me up is this, right? It's kind of like Seinfeld. If you ever watched that TV show Seinfeld, right? George Costanza, he's basically a loser in that show. However, for one episode, George was a winner, right? And because they told him that he was ordering the same sandwich, and they said, "Hey, go talk to that beautiful woman." He's like, "I can't do that." But like, listen, like George wouldn't talk to them and buy the same sandwich. Why don't you do something different? He's like, you know what? You're right. I'll do the opposite. I'll do the opposite of what I normally do. And so he gets a different sandwich, ends up being the same sandwich that beautiful woman gets. And then he ends up dating that beautiful woman. Then he gets his dream job with the New York Yankees by doing the opposite, right? And Jerry Seinfeld said, he's like, listen, if everything you sorry, I almost mixed up quotes there. He said, if every instinct you have has been wrong, then the opposite would have to be right. Most Americans have guessed it wrong, which is why we see it happening all the time. Give you an example is my own father. This is what got me away from being a financial advisor. In 2005, I sat down with my father because he said, Chris, I'm 61 years old. I want to retire at some point. And understand my dad was the penny pinching, cheap son of a gun, post-depression era mentality saver, right? This guy bought everything on sale, right? Everything. I grew up on case lots of boxes of cereal that would last us an entire year because it was all on sale. He always had to buy at a discount, probably because it was past pull date. I think I grew up on past pull date food. And so understand that he wasn't like the guy that was blowing his money. He was the guy that was saving every penny he could, and he was doing a great job of it. He was middle class. He wasn't broke. He was doing a great job. And so when I sat down with him and I looked at his finances for the first time, I said, well, Dad, here's the deal. You did a great job. You paid off all your debt, including your mortgage. He's 100% debt free. He'd also been stuffing money in his 401k, getting the match like every good boy should. This guy was Dave Ramsey's dream come true. And yet I had to tell him, like, Dad, based on the amount of money you've saved up and despite being debt free, you only have enough money to last you about 5 or 6 years. And then you got to go back to work. He said, well, that's not what I want to hear. What do I do? I said, I don't know. You did everything right from what I teach as a financial advisor. And that's the thing. Savers have become losers, even in dentistry and everywhere else. Like we've been saving and really, I call it the slave and save mentality, right? It's like we keep slaving away, putting money away, hoping that it's going to work, yet it hasn't been enough. And so understand that just like you're asking, right? Like if people keep doing the same things, they're not going to get different results. Right now, 2% of Fidelity's clients have over $1 million in their retirement account. But if you live on the 3% recommended rule, you only live on $30,000 a year at $1 million. So if you want even a middle-class lifestyle, you have to have at least $2, $3, $4 million saved up, which very few people have ever done with those same companies. And I know there's a lot more than 1 or 2% of people that are savers, right? We know that that's the case. It's a broken model. It has not worked yet. It will continue not to work. And what we've seen right now, like you mentioned, is people are getting lazy. They're becoming complacent because for 15 to the last 16 years, the market's gone straight up. No downs other than 2022 and it popped right back up like nobody even remembered it even happened. And so since 2009, and if you look historically, we have not seen this kind of a run in our lifetimes. Understand this is probably a once in a lifetime run that you saw in the stock market. Yet most people will get stuck because at some point it has to come back into balance. It's way too out of whack, way too far. And if my voice is not enough, listen to Warren Buffett. He just came out 2 weekends ago saying that he's got now 30% of his money sitting in cash. The guy that's supposed to be the greatest investor in the world right now has 30% of his money just sitting in cash doing nothing. Yet, what's happening? He's selling off Bank of America. He's selling off Apple whenever he's telling you to buy Apple. The majority will tell you to go the wrong way. Go with what the minority says. The wealthy do things differently, and that's what you need to do as well.
Yeah, absolutely. Warren definitely puts his cards on the table as one of the greatest investors, and yet he's utilizing the discipline and the patience that he's learned over decades. Understands when the markets are all-time highs, as we see them today, that's not a time to leave your money there. He's preparing and looking for the next opportunities, which we know are coming. And I think this is, Chris, and we know this because we met through, as you said, other groups. We have our own groups. We met through other groups because I want to have the collective wisdom of other people. I don't follow any cookie cutter model. Neither do you. Neither do any of the people that we are associating ourselves with. But we like to be really boots on the ground with people who have real experiences, not theory, not hypothetical, but are actually real experiences. And really, it's the access and relationships that we create there that provide the opportunities to any one of us to be able to do what we do, whether it's our businesses, our investment capital. It's really where I think my best insurance policy comes from. And I'm going to talk about insurance in just a minute, because that's a piece of something that I think you bring to the table that a lot of people don't know. But before we do that, could you let me know, is there one trend that you see, like over the next, just make up a number, 10 years, a decade, one trend that you would kind of bet on that you think is going to reshape the next decade, as opposed to what we talked about, what we've seen in the last 10 to 15 years with this, straight line up of everything? What kind of trend do you see that you're seeing that's going to kind of reshape what we've known in the past with recency bias to be something different that we're alluding to here today?
If we're talking about just financially, I think there's a lot of things in the culture, I think that will shift and change quite a bit here. But I think the biggest thing is going to be tangible assets, right?
Mhm.
Everybody's been talking about AI.
Mhm.
Everybody's been talking about tech. They've been talking about, stocks and everything else, and digital currencies and everything else. I'm already seeing it. I know you do too. We have a lot of friends and wealthy people that we know that are moving their money to tangible assets.
Mhm.
I think we're actually heading to more inflation, not less.
Mhm.
I could be wrong, right? I've been wrong before. But really, like everything the feds are doing right now, they're printing more money. Even though they're saying they want to control inflation, they keep printing more as if they don't want to control inflation, right? So we're seeing all these things happen that's really creating an inflation threat. Tangible assets is the only way you're going to win. Savers and those that try to just really survive from day to day will become bigger and bigger losers. Will find it less and less affordable only by having real assets, not digital, not made up assets or things that are like, it's almost like a copy of a copy, right? It's not the real master copy. It's like you're making copies and it eventually gets thinned
Derivative
out.
after derivative after derivative, right?
You
Yeah.
got it. Derivatives, exactly, right? Those kind of things, I think you're going to see that also blow up again.
So let's touch on something again. I know you're diversified with your investment allocations, what you do for your family, but the area that you have really made especially is in insurance. And I want to find that most of us, including myself, have always thought about buying insurance for protecting against those risks we hope never happen. In other words, I pay premiums for property and casualty. I pay premiums for disability. I pay premiums for health insurance, hoping that I never have to use those policies. Right? That's the goal. But there's a way to utilize insurance also for protection, but also as an asset. Without going deep into the tactical part, because that's something you can do offline one-on-one, but give people a little bit of the construct of what you know to be an asset and not just an expense on the P&L.
Yeah, like one thing I use as an asset is beyond just like you said, having insurance, which I do agree. Insurance is great because it allows me to transfer my risk away from me so I can focus and go more on offense with my investments, right? But one thing I've been using, like Warren Buffett's been very liquid on cash. By the way, that 30%, he's never had that much liquidity in
Mhm.
his entire
Right.
career, right? And so I'm doing the same kind of thing. I'm still investing, I'm still getting money deployed, but I'm building up more and more cash reserves to get ready. Now, I know if I keep it in the bank, I lose to inflation, right? Because I make point nothing percent and then I get taxed on that point nothing percent, which I don't like to have more taxes. And so what I'm doing instead is I'm storing more of my money in like whole life insurance, where right now it's paying about 6% a year tax free. It's protected 100% from creditors and lawsuits. So even if somebody sues me and wins, it can't be tapped into. My savings account can be tapped into, my IRAs can be tapped into, but this one's safe. And so I can actually store my money, not worry as much about that inflation that I'm worried about right now, right? I don't have to worry about that as much. I can have that ready and available to go and on moment's notice. And I can use that money not to try to have retirement, but instead use that money to actually invest in these real tangible assets. And so that's the strategy I'm taking is one, I'm building up extra liquidity, keeping more emergency funds over here. And I'm building up this war chest, getting ready to pounce to buy up even more assets while I'm still slowly accumulating my assets right now.
Back to your liquidity, right? I mean, that's the place where you're maintaining an asset, but you got the liquidity because that was your second tenet and in your new book. So having that
Yeah.
liquidity, but the ability to have it protected, very well protected. So it's you've got the downside risk protection, which we all want to some degree, right? We need to have that. So it's an asset class that Chris knows very well and has been really a huge advocate for our group and Freedom Founders in helping them design the right type of insurance product, which is the key. to develop their game plan, again, with specificity. Everybody's situation is different, Chris. And that's what I love about what you and I do and how we help other people is there's no cookie cutter to anything we do. It's always based on the end game that other people are looking for, really designing their future based on where they want to be at a certain time point, and then reverse engineering to where they are today, and helping them gain the clarity, really as couples and as a family. I mean, this is a family thing. This is not just a single person just running their business, but it all comes together with the family and what do they want, and helping them with the vision of what they see. And many times we all need to have outside eyes look at our situation and help give us the questions and provocations that help us like really define, well, what is it that we want? We can all build great lifestyles, right? Because we do good work, we can do great services for people, but where does our real freedom come from? Where does peace of mind come from if we're dealing in these volatile markets, which I know we're going to see for the next number of years? How do we gain more of a foundational footing in the volatility we have coming ahead? That's where I see is a lot of concerns and the things that we get to talk about. Chris, you're going to be with us at our Real Wealth Conference in October in Dallas. I'm looking forward to that. These are the kind of conversations that we get to have in that room, where we get to have a very functional and very transparent debates, because we don't come with a cookie cutter mentality. Everybody has different experiences. We all have different timelines in our lives. We have different pathways to get there. There's different ways to go, but being in a room where iron sharpens iron, I think, is one of the keys to what we have the opportunity to do in the rooms that we are position ourselves in by intention.
So true. Yeah, you got to be those events. I mean, that's the thing. You be with the right people in the right rooms, face to face, not just on a Zoom. Like I know some of us are zoomed out, but it's when you get those personal conversations, that's when your life starts to really begin to change, when you have those like real intimate and heartfelt conversations you have with others.
Chris, what gives you optimism in an era where I think a lot of people, whether they vocalize it outright, which no one wants to do, we all want to feel like we're optimists, but I know there's a lot of pessimism. Maybe not so much in our current generations, but we think about the younger generations, and they certainly there seems to be a lot of negativity. What gives you optimism for the bigger picture, for our country, even with all the things that are happening that we know are bad financial moves, that our government takes on? What gives you optimism in the long run?
Well, I mean, there's a lot of good reasons to be pessimistic, right? I mean, there's no doubt there's a lot of problems in the world, but when has that ever not been the case? All right, we've always had problems, right? Now we just have it. We just hear about it faster, I think is the big thing. And so for me, one of the happiest things for me is turning off the news, just disconnecting from that and really start to say, what am I seeing in the real world, right? What's actually happening? And being very selective about the voices I listen to. I think there's just too many voices, too many people screaming, yelling. The media is obviously paid to make you fearful and to stay engaged. Disconnect from that and then focus again. That's why, again, you want to be in the room with real people versus hearing what the media says. It's not the same thing. Reality is just so separate than what the media is portraying it to be.
Chris, other than coming to our Real Wealth Conference in Dallas in October, how can people find you? Where's places to plug in with you?
Yeah, anything Money Ripples, whether it's moneyripples.com or Money Ripples podcasts, even at Money Ripples on social media.
All right. Money rippling everywhere with Chris Miles. Chris, thanks for being here today. I appreciate it.
Thanks, David.
Okay. All right. Next up, a company, a platform that I've had the privilege of knowing and investing my capital for, well over a decade now. Mr. Bill O'Brien, PPR Capital. Bill, it's good to have you here today.
Hey, David, thanks for having me. Really always appreciate a chance to talk to you and your folks, your membership.
Well, likewise, I was just talking to Chris Miles, and we were just alluding to the fact that the real conversations that I say we're privileged to have, privileged only because we make those relationships happen. We all come from a different standpoint of what we bring to the market, whether it's wisdom, whether it's financial investment opportunities, which is certainly what PPR Capital does, and we'll talk a little bit more about what you see in the markets. But it's really the real time mixing up with people that are boots on the ground in the trenches is where I like to be. I certainly, like you, I'm sure, read a lot of economic material and look at the big picture, but on a micro level. I want to know who's out there doing what and what they're seeing daily. Let's talk a little bit about what you see through the lens of PPR Capital, many years, and we'll talk a little bit deeper about where PPR came from, a little bit about what you do today. But what's the overview in PPR Capital? Let's say looking out over the next several years, or you can even go a decade out if you want to take a bigger macro look. But Bill, how are you kind of positioning and looking at where the opportunities come from and where you may be wanting to hedge bets against trends that in the past have been very fortuitous for us? Give us kind of a macro lens, if you would.
Yes, you sure. And you know, as you know, David, our roots are we're in the mortgage note business. I mean, we started back in 2007 investing in second and first lien mortgages, things like that. And we've really evolved over the last 18 years, really into more of an investment management company. And what we did is we leaned into our strengths. Our strengths are investor relations, raising capital from great accredited investors, good people, and then putting that money to work primarily in real estate-based assets. Now, the notes are our mainstay. They will always be our mainstay. It's still our number one investment vehicle. We've invested over $100 million in capital into notes this year alone, and that translates to about $400 million in actual assets that we're managing from the note business. And in addition, probably another $80 million in multifamily properties. Again, diversifying the fund, providing a diversified fund to bring stability, diversification, and really lessen the risk to the investor. It's the whole point of doing that. We're going to continue to find ways to de-risk the fund. We'll always look at new asset classes for the fund itself to try and keep the risk down, but while at the same time creating growth inside the fund. And as you know, growth gets difficult at times. Sometimes markets lend itself to buying notes. Sometimes it lends itself more to buying multifamily. Sometimes it looks like build to rent could be a good strategy. And so I think what we're trying to do is to demonstrate to people all the time that we're very knowledgeable. We have good due diligence, we have strong underwriting, we have good surveillance, and we don't go into any of these asset classes with, unless we believe in it, unless we're strong and have good metrics that back it. We're a very data-driven company, and I think that's where we're trending. We're continuing to trend to look at data, bring more data sets into our investing, into our underwriting. We probably pay close to, $500 million a year, $500,000 a year just in data sets to come into our multifamily properties. So we're just gathering data everywhere and trying to put that to good use and making sure that we're moving forward. And what that means for us down the road is you're going to see more funds. You're going to see different types of funds. We're going to have our income fund, which you're used to. We're going to have a car wash fund, which is opportunistic. We might have a growth-oriented fund that invests in something mostly real estate related, but we could branch into other things. We want to be an alternative investment management platform. We want to be a place where investors can come, look at different types of investments that are out there, and know that we vetted them, that we've provided good due diligence, that we put them on our platform because we believe in them. And that's really where we're headed in probably five years or so.
Well, I've had the opportunity to also grow with PPR Capital because I knew one of the founders, our good friend Dave Van Horn, back during that era, and as PPR was getting off the ground, and I've been able to follow through our relationships, over almost 18 years now, and you're right, you're describing, I think, the same pathway that we as individual investors, which is what I am, an individual investor. We also have to be prudent about understanding the shifting tides, the movements of the markets. It's easy, as we all know, Bill, to get used to a trend line. And we've had some major trend lines, going back, coming out of GFC. A few years after that, we just had this kind of pretty steady straight line up in most asset classes. And that's been wonderful for those who have been in various asset classes and have ridden those to some high points. But there's also a time when we need to know when to make those pivots. And that's what you're alluding to is the note business is where PPR has always had a strength, will always be a foundational aspect, but there's been new opportunities or times when maybe there's not been as much ability to invest in notes because it wasn't the right time in the market. The market shifts. So where do you go? It's like I always say, Bill, where's the money moving? Right. Right. Talk a little bit about that, because I think that's really important. And we as individuals, we don't have $500,000 to spend on data sets, but we can have access to those data sets through our relationships with people like you at PPR that can provide us that, and then we can start to develop, well, where am I in my timeline of investing? Do I go with income because I'm leaving my active income pursuits, or do I want more growth because I'm younger and I want to?
Yeah.
So talk a little bit about those pivots that you guys have made over the years. A little bit
Yeah.
more.
So, so I don't know that I ever share. I mean, my background is actually traditional asset management. I was a financial advisor at Merrill Lynch for a while, and I had my own book of business and was in financial planning and estate planning and things like that. And so I always sort of try to harken back to those days and get people to realize that they have to look at two key things when you're trying to build your portfolio for yourself, including alternatives, right? Whether you build a completely alternative portfolio or whether you're going to use one that mixes in traditional stocks, bonds, and mutual funds and things like that. The two main things you need to ask yourself are, what's my timeline? When am I going to need access to money, and what for, right? I really believe in goals-based investing. Mm-hmm. You want to look at what buckets of cash do I need to serve a specific purpose at some point in time in the future? And then how much risk you need to take on that bucket depends on your timeline, right? So for instance, if you're, in your early to mid 30s and your timeline's 25 years to retirement, well, then sure, you can afford to be in a portfolio that's weighted more towards growth stocks or, maybe single asset real estate pieces or things that have a little bit more inherent risk with them. Mm-hmm. But then over time, as you get, as your timeline decreases, you want to back off and make that portfolio more balanced. Right. 60-40, 60-40, 60-20-20. You see more and more allocations away from fixed income to alternatives. And again, as you take equity off the table, you want to consider alternatives as a place to put that equity because it acts differently than a stock market. In fact, in a lot of cases, especially in real estate, it's not even correlated to the stock market. And so I think trying to educate our investors about that and why we make the moves we make is very important. And right now in the note business, for instance, the note business is tough. Our margins aren't there. We don't get great margins right now. We still get margins, but they're just not like we used to. So we've shifted some more of our asset investments into multifamily real estate. And people will say, well, we just, it just came off the highs in multifamily in 2022. Why would you do that? Well, we believe there's been a mini correction in the market right now. We believe that the asset prices have corrected in the areas where maybe they were overpriced. You look at Austin, you look at some of the places down in the Southeast where a lot of migration during COVID caused those prices to inflate. Well, we saw those prices start to come down, and we also stay away from those places. We're not big in real big cyclical markets. We don't like markets that are cyclical. We like stable markets. So right now we target the Midwest. We like areas that have steady rent growth in the 3 to 5% range, that have positive migration, but not fluctuating migration, steady migration, and rising incomes. And I think when you start to look at first where to invest when you're in the real estate side, you need to look at the bigger demographics. What's going on with the income? Are people moving in? Are they moving out? What are the trends in that area in terms of, the types of properties that are there? Are there a lot of Class A multi? Are they overbuilt? Is there a lot of workforce housing needs? We tend to stay in the workforce housing space. We like Class B. We like Class C. We like affordable housing. That's just where we like to be. And so I think all these things kind of go into your discipline around how you invest. And I think as an individual, you need to be disciplined and you need to trust your gut and you need to take gains off the table. One of the toughest conversations I used to have with clients when I invested was, well, I own, $3 million in Oracle stock at $85 a share. And I'm like, okay, what did you buy it at? Well, I acquired it in the 50s. Okay, don't you think it's time to take some of that off the table? And people just are reluctant to do that. Now it's been going up, and get up. And sometimes you have to reinvest your gains. You have to rebalance your portfolio. You gotta take your money and look into markets that are down because those markets are going to come back. You may not know when they're going to come back, but they're going to come back. And so I think, if anything, that's what I like to hear investors really dig into the discipline of investing. Knowing something isn't going to run forever. Be disciplined about taking gains off the table when you can, and look for opportunities to invest in markets that tend to be down because that's where you're going to get your best bargains.
Bill, with your experience as a former financial advisor, working with a lot of clients as you did, I'm sure many well-heeled and high income and high net worth. We're talking today, you and I, and on our Real Wealth Week live stream about investors, again, individual investors, taking more of a stewardship of their capital, their money. And I believe, and you can tell me, from your standpoint, is people who depend upon, again, good people who are well-meaning and do the best they can, that are with the major platforms, whether it's Merrill Lynch or more of a do-it-yourself through Schwab or Fidelity or Vanguard. Is the problem with that passivity is it only works for a time. And when we go through major shifts in the market, the inability to know how to shift and have the wisdom or discernment, it takes work. My point is, Bill, it takes some work to do this, right?
Correct.
Nothing's free in life. If you think something's
Right.
free, probably you're not going to get the goals. So with that big picture, and the people we mutually get to work with today, what's kind of what do you see as the main characteristic, the avatar of the people that we like to work with who want to dig down? What's different? What are they finding in their life that they are making time for to learn more about the financial side of their life versus the business, which they're always hands-on in?
Yeah, I think that's the challenge, right? It's trying to find the time in your day when you're running a business to educate yourself about, investing and making good decisions and being prudent. And I think one of the things that I loved about your workshops and the conferences and the things that I get to go and attend to is I know that most of your folks have been through your planning. They've been through your sort of your blueprint days, and you kind of are laying it out for them on, here's how you set yourself up for success. And I think it's the same thing in investing, right? You have to take the time to really understand the type of investments that you're looking at. Alternatives are not easy. They're not easy to get a lot of information on. They're private investments, right? So, you really need to take the time to read through your PPMs that you get from your folks. You need to really educate yourself around the investments that you're making. One of the things we were just discussing today on our team was how do we make it easier for people to get the salient points out of our PPMs? Maybe there's a way we can use AI to summarize and get just key talking points out to people to make it easier. It's so hard to look at a 65-page document and pull out what you need. And so we understand that as an investor relations department, that we need to do better and make it easier for folks to see what they're investing in and where that, not be afraid to be transparent, show them this is the language you're going to see in here, and here's what it means. And I think as responsible sponsors, we need to take, I think, a step in the right direction and do that. And so that's something we're going to work on for this year going forward, is to really make sure our clients understand the details of a PPM, what we're investing in. We're also going to look at, possibly educating our investors around the art of a deal. How do we make a decision on a multifamily investment? For instance, we go through a lot of due diligence on it before we even take it to our investment committee and get 5 people to vote to say, yes, this is a good investment, right? So how can we help, again, bring some of those tools that we use to your members so that they, when they're looking at a syndication deal or there's other opportunities for them, that they know how to put those tools to work. And that's something that I think that we need to get better at as well as sponsors, is we can't rely on, Bill O'Brien's good faith and great smile and all that good stuff to get the information across. I mean, it's good. And I love that people trust me, but I also want people to be educated and I want them to know what they're investing.
Yeah, we're definitely on the same page there. And to that point, there's a time when the complacency, and we all develop complacency in different parts of our life when things are going well, right? We just kind of
absolutely.
I'm good with that. And today we know we're in a marketplace where, again, diligence is the key. Whatever you're looking at, business investments, and doing it as a group of like-minded people. So we've taken the same approach with a lot of the PPMs. Same point. I don't want to read my pages, but give me the salient points, and then you got a small group of people who can dig in together and toss the ideas around. You learn so much more because that way you don't have to do all the lifting yourself, but you got the opportunity to bounce ideas off other people. And I will also say, PPR has always done, I think, a really, really good job with the education you provide, which I want to talk about here in a minute. Is where people can further connect with you, Bill, and PPR, and some of the education that you put out. Why don't you go ahead and give that to us now so we can just get that out to our listeners?
Sure. The best way to get a hold of us is go to our website, pprcapitalmgmt.com. You can book a call with one of our investor relations team, and they'll walk you through the investment process. But you can also download a lot of information. There's information just on notes. There's information on each of the funds that we supply. as well as our latest update in our prosperity report. We put out a quarterly update, which I've been real proud of it lately. We've been really beefing it up and trying to get even more and more information into that report. It's probably the best way to get sort of a snapshot of what we're doing right now every quarter. But all that stuff is available on our website, or you can reach out through the portal on the Freedom Founders portal and obviously talk to myself or Stephanie and set up a call. But we're happy to talk to anybody one-on-one.
Bill, 10 years from now, what do you think many investors will wish they had done more of, or maybe less of? If you could kind of give a trend line there, what do you think?
Definitely alternatives. You definitely need to be in more alternatives. That's the trend. Stocks are declining. The number of public stocks continues to decline year over year. It's no surprise. Most of the cash out there is in private hands, and they do private deals now. So there's just no need for public offerings. So you're not going to see as many stocks out there, number one. So you need to find something else. Number two, real estate. Why do I say real estate? As somebody who was involved with high net worth people for a number of years, the number one asset class, if I asked them what was their best performing asset class over the years, number one was always real estate. Whether it was their home, a vacation home they bought, the building that their business was housed in, every one of those folks had access to some sort of income producing or asset growing real estate. And that's one of the reasons I came over to PPR. I was so enamored with the asset class, how consistent it was, how diverse it was, how you could build a whole portfolio just around real estate if you want to. And for me, I wish I'd learned it 30 years ago, to be honest with you, David, but that was a big revelation to me just in the last 5 to 10 years, that it's really an asset class that is stable. It has its hiccups. It's like anything else. I mean, you had the big crash of 2008, but I think, when you look back on that, most of those crashes come from systemic problems, right? In that case, it was a mortgage problem. They weren't issuing good mortgages. There was a lot of sort of Wild West out there with mortgages. Well, that's all under control now. And so anytime you see a big change like that, typically regulation jumps in and slows things down and kind of sets it back on track. So while I think real estate will have its ups and downs, I feel like it's probably, from a consistency standpoint, one of the best performers out there.
And look, there's always ways to hedge the cycles and the downside risk. You talked about earlier on using notes as a stable, understanding when to pivot, when to shift. And I think that's a lot of people inherently don't understand the different tranches that we can use in real estate. People think typically of equity as being the only place to go, and it's not the only place to go. Back to the point where PPR came from. It wasn't equity, it was in credit. So balancing the two and understanding when to shift, when to pivot based on buckets of money, where people are in the timeline of their career. So many things that can be customized to various people, and it doesn't have to be just all in or all out. I think diversification is the key.
Yeah, for sure. We're going to put a debt fund out next year to give you an example. Just another way to diversify where it puts you higher in the stack, even less risk than the RIF fund. With a consistent pay structure. But again, just understanding the different classes out there and what you have available and making use of them is really the key.
Bill, again, I know PPR, the kind of research that you do, you've alluded to, but I know you've got people on the team, economists, people that really study the big picture. Is there a particular trend line, just again, a macro level trend line that you're kind of looking at as a company? We could talk about, is it for the long run, is it inflation, higher rates for longer, or is it still just too early to say where the moves are going to be made? I know we're looking at 2 weeks from now, the FOMC will be meeting, and people are like hung up on what's the Fed going to do with interest rates, and is that more noise than signal, or just how do you guys look at that?
Yeah, I mean, we so Spencer Staples, who's our chief investment officer, is also a market watch economist. He actually picked up a Bloomberg now, and so he ranks and puts out forecasts every week on the different parts of the market that he follows, the PPI, housing, all those things. You'll start to see those pop up on our website again as we move forward, as he's become more sophisticated and our models are back up to speed. You'll see more of that from us going forward. But his take on interest rates right now is he believes in probably a 0.5 point cut in September. He believes the data is there to support a 0.5 point interest rate cut, and then possibly one more before the end of the year. That's the one that's a little tricky, but there's enough data that's come in over the summer that is pointing to them needing to cut the interest rate down. The second thing is the housing crisis has not gone away. There's still a demand for at least 3 million plus single family homes in this country, and they're only building 600,000 a year. And so there's going to continue to be a demand for single family housing, workforce housing, and affordable housing in this country. It's not going away anytime soon. And we are leaning into that. We believe that's a good opportunity for us and for our investors. And I think those are the two biggest metrics that we watch, and the ones that we keep an eye on. Unemployment's probably the third, kind of lags behind a little bit, but we really don't see unemployment being a huge problem yet. I think there's been a little bit of a slowdown in jobs growth, but not really the massive layoffs or anything that you've seen in the past. And so we're pretty bullish on employment as well.
Bill, you've laid out a lot in a short period of time here today. The fun part is we get to have more of these conversations. You'll be at our Real Wealth Conference in Dallas in October. Looking forward to that with some of your team. And again, people that want to follow up with you directly, we've got that information out in the show notes. Bill, it's always a pleasure. Thanks for being here today.
Thanks, David. Appreciate you having us, and we'll see you in October.
See you soon.
Take care.
Mm-hmm. Bye-bye. All right. Up is my buddy from Denver, Colorado, Mr. Jake Vanderslice of Van West Partners. Jake, always a pleasure to have conversations with you. I never know exactly where they're going to go because you can take deep dives into so many areas that are of interest. But for our general listeners today on our Real Wealth live stream, let's talk a little bit about the macro, the big picture, which, again, you're macro and micro. That's what I like about you. You can go both directions. Let's give our audience today, our listeners, a little bit of your viewpoint of where you see basically economic trends, and you can be general about the economy as you wish, or you can apply it a little bit more to the area that we talk a lot about in alternatives in the real estate markets. We'll get into a little more specifics, but what's that trend line? You want to pick on something like interest rates, inflation, demand for housing, and we'll get in, to obviously storage, which ties into housing a lot. Give us a macro view of your sense of where we're going the next 10 years.
Yeah, we'll start with interest rates, and briefly, I'm live from a hotel room in Vegas. I just got here for the annual Self Storage Association conference, and I wish I had the benefit of having this call with you after getting everybody's kind of viewpoints over the next couple of days on what's happening out there. We'll start with interest rates, though. I was hearing PPR talk about the potential rate cut before I got on here, and I think that's going to happen as well. And people talk about interest rates going down, and it's a tale of two cities. It kind of depends on what kind of interest rates you're talking about. So the interest rate that Bill's referencing is the federal funds rate, which is closely correlated to the secured overnight financing rate, or SOFR. There's forward curves out there for all these different interest rate indexes, and the forward curves are generally wrong, but nonetheless, SOFR, or the federal funds rate, is going down and to the right in the forward forecasting. And I believe about a year from now, it's forecasted to be down by about a point. So maybe we get 50 basis points next month. Maybe we get 0, maybe we get 25. Is there one more before the end of the year? Who knows? But SOFR is forecasted for the foreseeable future to be going down. Now, the other big index that we track are the treasuries, the bond yields. And the bond yields are heavily correlated to interest rates on longer term debt. So SOFR and the federal funds rate is more on bridge debt, shorter term maturities. We have a lot of construction loans and acquisition loans that are indexed with a spread over SOFR, which again is basically the federal funds rate. And we've had some tailwinds on those because that rate's gone down depending on when we originated the loan. It's a floating rate loan. Now, if we're refinancing into term debt, a lot of the term debt that we're either refinancing into or using to buy maybe a more stabilized deal is indexed against the treasuries. And the forward curve on the treasuries is going up and to the right. And that could be a problem for a number of reasons. The first problem could be treasuries are, especially the 10-year treasury, that's heavily correlated to the 30-year mortgage rate on single family homes. So you could have this dichotomy of the federal funds rate going down, but bond yields going up and long-term interest rates going up. And in commercial real estate, if we're financing, say, a 10-year fixed, a lot of those 10-year fixed loans that we're financing are indexed against the treasuries. So not only would the 30-year mortgage go up, potentially, but we'd also see maybe a slight increase in our term debt financing as well. So it's a confusing climate, obviously, for lots of reasons. But again, you could see shorter term loans, bridge loans going down, and longer term interest rates going up.
Jake, who controls the longer term bond rates? Powell?
Well, yeah. Well, as much as the as our administration would like to believe they can control the 10-year Treasury, that is controlled by macroeconomic conditions, and typically bond yields are a reflection of risk. And bonds trade like cap rates. For those of us who understand cap rates, if bonds go up, the value of the if bond yields go up, the value of the bond goes down, and vice versa. And typically, when the economy is, when investors are confident in the economic outlook, bond yields will compress and / increase in value and decline in the rate that they pay. And then vice versa. If people feel like the economy's in a great position, they'll take higher risks with equity, with alternatives, and they'll sell off their treasuries or not buy treasuries, then those yields go up. So it's really they're really controlled by major macroeconomic forces that I can barely begin to understand. Now, the federal funds rate, obviously, even though the Fed is supposed to be an independent entity, which I still believe it is, no doubt there's some influence there, but the Fed can only do so much to have an impact on bond yields.
I still have this image. It's been a few weeks, maybe 3 or 4 weeks, but Trump and Powell were on site at the Federal Reserve Building. I don't know if you saw that. And Jay Powell is a little bit more diminutive in stature, and they were out there. They both had hard hats on, and Powell just looked like he didn't know what was going on. It was a bad scene. But to your point, they're supposed to be independent. I feel like there's a lot of strong arm going on there, but I have no idea how much. But what I see as a problem is from a standpoint of the general economy and what the administration wants, is they'd love to have the federal funds rate, short-term rate, down because that does add some juice to the economy. Certainly keeps the stock market juiced up, which is, I guess, where a lot of people have their flagship. It's like, well, the economy's doing great because look at the stock market, right? And it's way overvalued. And then we have the longer-term bond rates, as you alluded to, that are macro, meaning that it's investors, it's sovereign debt. Other countries, buy that because they want the reserve currency backing their assets. But if they're seeing the tendency for inflation to be coming back strong, which I sort of think it's going to, and at the same time, interest rates, short-term rates, SOFR rates are going down, what's that telling me is a long-term bondholder, a debt holder? I need more juice. I need higher interest. So
yeah, and briefly putting sorry to cut you off, putting this in reverse for one more point here on the bond yield component. That could be a problem for real estate values. Well, if you think about it, let's say the bond yield, the forward curve shows it going up over some number of years to 6%. It's currently in the low 4s. I hope it doesn't go up to 6. But if that happens, think about real estate cap rates. So let's say that a Class A high quality asset is trading at a 5.5% cap rate. So that investor would pay the price for it, and they would make the equivalent of an unlevered 5.5% yield. Why would someone go out and do all the work by owning and operating real estate to get a 5.5% return when they can buy a 10-year Treasury for a 6? Yep. So that could create some upward pressure on real estate cap rates, and in turn, downward pressure on commercial real estate values. And maybe rent growth will outpace that cap rate expansion if that happens. You mentioned that you don't think inflation's going away. I don't think it is either. So maybe it comes out in the wash the other side. But that's one more among many concerns about kind of the direction that forward curve is showing us today.
Okay, perfect. You went right where I wanted to go. So with that in mind, we just talked about, then where do you see the potential for opportunities if interest rates on the long end of the curve stay high or potentially even go a little bit higher? Then commercial valuations, the inverse, will have got to come down. Now, if you've got a stabilized product, which I know is what you focus on all the time, stability, the need, you've got term debt that is producing the cash flow margin that you need, well managed, you can run through that. You can manage through that. but a lot of people are still stuck on shorter term debt, which fluctuates, and they can't stay there forever. What do you see as potentially opportunities? What are you looking at Van West as opportunities? You've got great holdings right now, but where are the opportunities coming? What data points are you trying to look at out in the field today?
Yeah, we thought there was going to be a meaningful slowdown in 23. That never happened. We thought the same thing in 24, and here we are, well over halfway through 25. And no doubt there's pain out there, but we haven't seen this macro measurable asset devaluation. And returning to cap rates for a moment, cap rates are still largely compressed. I mean, values are still pretty high. And when does that break? You do the math on financing a deal at 7% interest and you buy it at a 5.5 cap without a lot of value creation upside. That math breaks really quickly. So you got to think there's going to be some level of measurable duress that's coming down the pipeline here if we don't get some interest rate relief. We're looking. We're seeing a lot of new opportunities in merchant developers who were used to building. We're in the self-storage business primarily. They were used to building self-storage facilities and then selling them at C of O and then doing it over and over again. Those guys are hurting badly right now because first of all, they finance those deals with a construction loan that's got a shorter term maturity date. And generally they're not operators. And people are not generally taking the risk of buying an empty building right now. If they do buy an empty building, they want it heavily discounted because the forward forecast is so opaque, right? Where are rents going to go? What's consumer demand going to do? So we are seeing more kind of distress opportunities there. I wish I could tell you that, oh yeah, these 5 things right now are great opportunities. It's really just, regardless of your asset class, we're trying to mitigate downside and achieve measurable, quantifiable, reasonable upside. And regardless of what asset class you're in, we're just not seeing that many opportunities out there where you can accomplish those 2 things. There's still a bid-ask disconnect. And deal flow is challenging. I can't imagine that's not going to change sometime soon. But I've been saying that for a couple of years now, and sometimes the broke clock is right twice a day, and I've just been wrong 100% on that distress coming.
Jake, what risk factors do you think a lot of investors, retail investors, are blind to today? Looking back over the last 10, 15 years. In a lot of FOMO and a lot of upside in most asset classes, at least in the equities for sure. What do you think a lot of investors are blind to today? Is there still a reach for the stars? In some cases, there's still a lot of FOMO. What's your feeling? You talk to a lot of investors. What do you see?
Yeah, and I'm not going to say they were certainly blind some number of years ago, and a lot of folks have had some hard lessons in kind of asking the right questions on the deals they're investing in. But I think one thing that people cannot focus enough on, if you're considering investing in a single asset syndication or a fund, understanding what the debt terms are is really important. When does that debt mature? What are the loan covenants? For those of us listening, you've probably heard that term before, but commercial real estate loans are not like a mortgage on your house. They check your income, they check your credit, your balance sheet, they give you a loan. As long as you make your mortgage payment, they don't care if you have a job or not. They don't care what your liquidity position is. And commercial real estate finance, there are all kinds of landmines that are called loan covenants that if you trip one of those covenants, your lender can make you right-size your loan or accelerate your loan. So not only understanding when the debt matures, but also what the covenants are in that loan. When do you have to get to a certain debt coverage ratio and on what year? And show me your business plan and how you're going to do that. And if you're not showing me a refinance before your loan maturity, why are you not doing that? What assumptions are you making going forward? But I just think understanding at a basic level, asking 5 or 6 questions, understanding what the debt terms are is really important in this environment. And asking questions like, don't tell me so much how I can make a 20 IRR and a 2.5 multiple on this deal. Tell me the story about what has to happen for me to lose my money. First, to lose a piece of my money. And then secondly, tell me what has to happen to lose all my money. And the answer to that could be cap rates go up, or we miss our NOI growth projections by half, or interest rates go up by 50%. Typically, there's a lot of bad things that have to happen. for someone to see an equity wipe, but unfortunately, those bad things have happened frequently in the last 18 months. So asking about the downside and asking about the debt, I think, are important.
So those are definitely the right questions, and you're always on the forefront, Jake, of actually leading with those comments. Oh, it's what I love about you is you sell no hype. You're just as steady as they go. So if I ask you, if somebody want to put money into equity in self-storage today, what time frame should they be thinking about? Because that's always when the markets are running hot and fast and money's turning over quickly, people are all about, as you said, the quick turns, the high IRR. What should people be looking at today? Not just with you, but long term in equity, in the right equity opportunities, asking the right questions. What should people be thinking about in terms of time frame?
Yeah, we try to set the table as much as we can early on, and this is not unique to us. Depending on how you're structured, though, there's generally two common elements in a private placement, private real estate offering. One is you have a lack of liquidity, right? You can't get your money out unless it's a debt fund or it's a REIT of some kind, just a normal 506e, single asset syndication. Your capital is stuck until the deal is ready to get your money out. And the second common element is just like buying a stock, your money is at risk of loss, right? Anything could happen, values could go down, whatever issues could kind of arise. Your capital is at risk and your capital is not liquid. As far as timeframes go, a lot of sponsors, including us, especially the last 18 months, we try to set expectations for about a 5-year hold period. And that's not set in stone. If you're investing in a deal because the pitch deck says 5 years and an 18 IRR, and you need to get out in 5 years, understand what that 5-year horizon means. In our case, and I think a lot of other investment managers' cases, that 5 years is just a business plan, and business plans never go exactly like you think they will. And in many cases, for good and for bad reasons, we've held deals longer than our hold period guidance, and we've sold deals a lot quicker than our guidance period was. So I would expect to be strapped in for a while in an equity investment in a real estate vehicle. But 5 years is kind of the business plan guidance we've had on some of our pseudo recent deals, I would say the last 18 months.
Jake, how can people connect with you? They'd like to learn more about what you do in self-storage, but also just some of the wisdom that you've just brought to us in a short period of time today. What's the best way to connect?
Yeah, I'm a principal at Van West Partners. We're primarily a self-storage owner operator. We own about 21,000 units and 41 facilities. People can go to our website, vanwestpartners.com. They can hit me on LinkedIn, Jacob Vanderslice, or they can email me, jacob@vanwestpartners.com.
Very good. Let me ask you another question. How does your strategy, your philosophy in self-storage, how does that help investors protect against the uncertainty and a lot of the volatility that we're expecting? We have it right now, but your strategy, and you kind of alluded to it, but let's just kind of nail it as to your philosophy and how you look at the longer term.
Yeah, we target acquisitions that have an element of operational inefficiency. Their rents are below market, their operating expenses are above market. Maybe they don't have a website, they're not advertising well. And most of our value proposition comes in the fact that we self-manage our entire portfolio. We only manage our portfolio. Our models, as you've heard me say many times over the years, David, are typically wrong, but they're usually wrong in the right way. Nothing ever goes like the Excel spreadsheet says it will. But value creation in real estate, I think, comes down to one fundamental part of your business plan, and that's growing net operating income. And if you're growing NOI, meaning you're growing gross revenue, less expenses, not including debt service, and you're managing your debt effectively, you're going to inherently over time create value. When you've got a debt maturity wall and your NOI is declining is when you get into trouble.
Jake, really appreciate your time today. We'll see you in Dallas in October at the Real Wealth Conference. Can't wait to have more conversations with you and the others. It's going to be a lot of fun. Enjoy your time at the Self-Storage Conference. Love to hear some takeaways from that when you get through, because I know that's where you'll gain a lot of additional insights. But again, thank you for your time today.
No, I'll do my best. 2 nights in Vegas is too many.
Okay.
Take care.
Take care, Jake. See you later. All right. Good afternoon, David McElvaney. It's always great to see you, sir. It's been a few months. Time flies when you're having fun, but also there's a lot going on in the marketplace today. David McElvaney, McElvaney Wealth Management. We've had the pleasure of knowing each other for I think at least five years now. The book that you wrote that's so well received, The Intentional Legacy, was the piece that got me interested in who you are and the opportunity that we've had to do a deeper dive, just both personally, but also through Freedom Founders. Has been nothing but a pleasure. I want to just give kudos to you. For people who don't know you, I mentioned the book, The Intentional Legacy, which I would recommend to anybody who's thinking long-term about family and succession. But also, David hosts a podcast, a weekly commentary, the McElvaney commentary. Each Wednesday it comes out. In fact, that'll be tomorrow morning. Your next one will come out. I don't miss a week without catching that somewhere, wherever I am. You've been doing that since I think 2008. So you've got a lot of years. There's just a ton of information there, and we'll talk about more where people can connect with you. But I just wanted to lead with that, and I appreciate you taking a few minutes today just to talk about, in general, the markets, David. And the first thing I'd like to pose to you is, obviously, through your family, the legacy that your father set up, and being first and foremost involved in precious metals, but expanding beyond that into commodities and more macro wealth management for clients who wish to have your support. We've talked a lot, in our conversations in the past several years, as we see in the markets start to tilt, that moving more towards what we would call the hard assets, tangible assets, assets that are connected to the earth. Certainly, precious metals being one of those commodities. You can talk about real estate. What are the signals that you have watched on a macro level that certainly would focus on making that pivot to some extent in one's portfolio?
Yeah, I think the two biggest factors that drive success in hard assets are, sort of environmental aspects. And by that, I mean sort of contextual elements. If interest rates are in a declining trend for a long period of time, that favors financial assets. It favors leveraging up a balance sheet, and corporations that are asset light do really well in that kind of environment. When inflation becomes an issue, then interest rates tend to creep higher, and that represents a headwind to financial assets. It also becomes something of a tailwind to hard asset strategies like ours. So whether it's the physical metals, which are sort of wealth insurance, or something that is more focused on wealth creation, which would be publicly traded companies that are tied to companies that operate somehow in the hard asset space. They tend to do very well with those contextual issues in play. So interest rates, again, a lot of times, if you're thinking about what an interest rate is, obviously it's one part of a loan obligation or an IOU, and it includes time, and people need to be compensated for the risk that they're taking, the assets that they're putting in play, and one of those risks is inflation. So rates come down typically in a low interest rate or in a low inflation environment, and to the degree that you have inflation as a lingering issue, rates stay stubbornly higher. So we think we've got a period of time where inflation does stay stubbornly higher. That doesn't mean double digit. It doesn't mean catastrophic, but it does represent something of a challenge to financial assets at certain thresholds. And so we favor the hard asset strategies for the foreseeable future. I mean, I think you've got a good 3 to 5 to 7 years where hard asset strategies make more sense than the financial asset markets.
It's difficult, David, for a lot of retail investors who may be very sophisticated in their business acumen and pretty good with money. It's difficult to not look at recency bias. And by recency bias, we could go back, 5, 10 years coming out of the 2008 GFC, when, for a lot of reasons we won't talk about here today, but there's been, a huge uplift in the financialization of a lot of the assets that people traditionally default to, which is Wall Street products. Not dismissing those. Certainly people who have been in those products have done pretty darn well in the last number of years. But you spoke, I think, too, about trends. And very few people will go back beyond, the GFC. If you go back to 1980, and you talk about this, all the time, about the fact that we have had this declining 40-year period of interest rates, at the height of the Volcker era, all the way down to 2021, when we essentially had the federal funds rate, at 0 or 25 basis points. And the tailwind that those declining rates provided for a lot of asset classes we've kind of flipped the switch. And to your point, I also believe that inflation is definitely in the forecast, even though we have the Fed, we have the government officials speaking about, taming it, keeping it down, watching those numbers every month. Certainly a lot of manipulation in those numbers. We know that for a fact. But I think the writing's on the wall when we see no austerity at all in the government. It's spend. In fact, I think today, really, if I had to put a philosophy behind, Scott Bessent, it's we're going to grow our way out of this, and that doesn't mean going lean and mean. It means try to be robust and grow the economy. But the spending and the debt that has continued to accumulate, particularly over the last 10, 15 years at a very, very exponential rate, I believe is kind of the elephant in the room. Can you speak a little bit to our audience today in the short time we have is to a little bit more about how you see inflation and therefore interest rates, especially the long end of the curve, probably persisting at a higher level than some people would hope it would?
Yeah, I mean, we've got a couple of weeks now before the FOMC meeting, right, September 17th, and there's a 90% probability of rates being reduced by 25 basis points. The danger of lowering rates, either 25 or 50 basis points, is that inflation is not fully tamed. We've got CPI, PPI, and PCE, which are all three different measures of something similar. Just different things get thrown into the basket, other things are excluded. And we're still between 2.9 and 3.3% on any of those three measures. The target's 2. We can't get to 2. We've done everything we can to get to 2. And 3 months in a row, inflation has been creeping higher. This is a pretty interesting period of time, because if the Fed is trying to squash inflation, they need to keep rates higher.
Sure.
And yet the president doesn't want that. The president's putting all kinds of pressure via Jerome Powell and now Lisa Cook, and trying to oust Lisa Cook to basically, stack the FOMC board with people who will lower rates. And lowering rates is great for asset prices. But if inflation is not tamed completely, then you actually tempt fate with even worse inflation down the road. And so one thing to be watching for over the next 2-3 weeks is whatever happens from the FOMC meeting, watch the long end of the yield curve. If you're watching a divergence between those two, the spread between short-term rates and long-term rates, if that gap widens, it's an indication to you that the bond market is not happy with the decision. And the bond market expresses itself more clearly as you move further out on the yield curve. So that's going to be pretty telling. We've got 2 significant data points coming out in the next 2 weeks. This week is non-farm payrolls and the employment numbers, and that may be a catalyst for the Fed lowering rates to make sure that we don't have an issue with unemployment. On the other hand, we've got CPI and PPI next week, just before the Fed meeting. And so, I mean, what I'm forecasting is a football which is tumbling through the air, and it may hit the ground, and it could bounce one direction and it could bounce the other, which is not particularly helpful. What we've seen in the precious metals market is a pretty clear signal that there's concern about Fed independence, and that if Lisa Cook is kicked to the curb, that the greater cost is policy capture by the Federal Reserve, or by the White House rather, and the Federal Reserve won't be operating solely towards its two explicit mandates. The third mandate may be, duties as assigned, in this case from the new, shadow Fed, if you will, who's taking calls directly from the Oval Office. We're at a dangerous place in terms of the markets, because if you have incredibly high amounts of liquidity in the financial markets, and which we do today, Chicago Fed runs a number for sort of financial conditions, their financial conditions index, and it's measuring basically some of the loosest financial conditions on record. So Jerome Powell can say, "Oh, we've got tight conditions because the interest rates are high." No, there's so much liquidity in the markets today, it's unbelievable. Which is one of the reasons why equities are doing so well. There's plenty of liquidity, plenty of opportunity to speculate, not only with your own money but with other people's money as well. We passed $1 trillion in margin debt last month, and it'll be interesting to see. Well, for July, we'll see where the August numbers come out. I think it'll press higher in the month of August as those numbers are reported.
David, what do you see as potential trigger points for decreasing liquidity, a credit contraction? What could be some triggers foreseeable that could turn the tables on the amount of liquidity and speculation that we have right now?
If PPI and CPI come out and are uncomfortably high, then the Fed may not only keep rates where they're at, arguably they could raise rates. And again, I mean, this is following what's called the Taylor rule. John Taylor's been a guest on our commentary before. He teaches out in California, University of Berkeley, and University of California, Berkeley. And the Taylor rule from the 1980s forward has been sort of the guide of where interest rates should be in light of the prevailing interest rate. And according to the Taylor rule, rates are exactly where they should be. If inflation pushes higher, and if it's uncomfortably high, then there's going to be a case to be made for increasing interest rates. Nobody in the financial markets is prepared for an increase in interest rates. 90% probability of a rate cut suggests that everyone is assuming, 90% are assuming that we're going to get a cut. If we actually stay flat or move higher, I think that's where you have outright panic in the equity markets. And we could set up for declines that we haven't seen in a lot of years, 20-30% just to get things started. Off of these kinds of valuation peaks, it would not be uncommon to see a 50% decline in equities. And when I say off of these valuation peaks, if you look at trailing price to earnings, if you look at forward price to earnings, if you look at the cyclically adjusted price earnings ratio, if you look at price to book, if you look at EV to EBITDA, if you look at the Q ratio, if you look at the Buffett ratio, or want to combine those into an index, we are at the most overvalued the stock market has ever been. That takes out 1929, takes out 1966, that takes out 1999, that takes out 2021. And so we're at these levels where everyone's assuming one thing about Fed policy. If the Fed zigs when the market thought they were going to zag, disappointed expectations on Wall Street, outright selling, liquidity starts to dry up very quickly. And liquidity abundance is when basically everybody's put all their chips on the table, is willing to play not only with their money, but the house's money. Liquidity dries up when all of a sudden people say, not as I expected, time to rein in risk, time to degross our positions, time to shrink back, raise cash, and create some hedges. So not a lot of interest in hedging today. Cash positions amongst mutual funds near record lows. Nobody's really prepared for downside. So you'd see a mass scramble to get out of the way of a declining market.
It will happen very quickly with no margin today, is what you're saying. Is when something triggers.
Yeah, and a part of that too, David, is because people are overcommitted.
Yeah.
We've never seen margin debt numbers exceed $1 trillion until July. And arguably August, I think August will be, 1.1 would be my guess. It's such an aggressive market. And you can see it in people playing meme stocks. You can see it people, going all in on the AI trade. When, it was very interesting. MIT ran a study last week, and this is one of the things that sort of took some of the buzz out of NVIDIA's earnings report last week. MIT's report basically said 95% of companies that have invested in AI initiatives have yet to see any financial benefit from doing so. So we are building a technology which is massively transformative of the future. We just can't figure out how it's going to actually make any money for anybody. Meanwhile, we'll spend $375 billion domestically on AI expansion, $500 billion next year on AI and data center expansion, because we have this belief in a narrative. That narrative is beginning to shift. And I think that MIT paper is kind of a shot across the bow for folks who are way overextended in the Mag 7, in NVIDIA, in all the things that have been working. Speaking of recency bias, people like what's been working.
Sure.
And, one of the reasons why we haven't seen a lot of interest in precious metals is because people are still on the same old bandwagon, playing the Mag 7, long equities, and borrowing from, your Fidelities and Schwabs and their margin accounts. So it may come as a surprise for your listeners to hear that there's not a lot of interest in gold and silver today, with gold and silver hitting all-time highs today, at least for gold. And for silver, it goes back to 2011. We're at least as high as we were in 2011. But the retail investor is not present. The mover of the market over the last 12 to 18 months has been central bank demand for gold. And only starting in June has the retail public started to take any interest in silver. So for us, the sort of confirmation that we're moving into the next leg of a bull market higher in gold and silver is the retail investor beginning to pay attention. We see that in the ETF flows. We see that in the interest in mining shares, and we see that in silver. And so really, you're talking about a 2-month period where we've begun to see an inflection point, investors starting to pay attention. But this is not an over-owned space. Is it an expensive space? Yes. But is it over-owned? Not at all.
Yeah, I think that's the key that I wanted to make sure that people understood, because so oftentimes people are late to the party, or they stay at the party too long, right? Or in this case, we've seen back-to-back high returns in the precious metals last year, this year to date, and maybe people say, "Well, I'm too late. I'm too late." And as you said, it's under-owned today, particularly in the Western countries, right? You just haven't seen it except for the last couple of months. So, as a hedge, and again, you speak to this on a regular basis, whether it's the commentary or other talks that you do, but as a hedge, precious metals continues to provide a strong basis against a lot of the volatility that we're no doubt experiencing and will continue to experience.
Yeah, I think, part of succeeding in any investment endeavor is having a strategy. And, if you don't understand the market and you're just throwing money at something, it's a great way to get upside down in a hurry. What I would suggest is, working with our team. Jeff Dobish is a primary point of contact for the Freedom Founders Group. Putting together a strategy is absolutely important. What does that look like? Well, even with a move in gold and silver, the gold-silver ratio is at 87.5 to 1 today. And at 87.5 to 1, you've got latitude in that ratio to shrink towards 40 to 1, which would basically be, in layman's terms, silver outperforms gold's next move by 100%. And so what we do is structure a portfolio to be able to play the differences between the ratios and with premiums that allow us to compound ounces to where, 10 years from now, if you're dealing with twice the number of ounces that you have, the spot price becomes less and less relevant.
Right.
Now, the next 10 years, as you double what's already doubled, the spot price really becomes irrelevant, as you're dealing with a zero cost basis portfolio. You can take out your gains, move on to other assets, and have zero cost basis in your metals. what is still there and allocated towards, this insurance, wealth insurance, if you will, you can continue to play the compounding game if you have a strategy. If you're just trying to pick a price and hope for the best, maybe silver's higher tomorrow, maybe it's lower tomorrow. I can't tell you from one day to the next what it's going to do. I think we have an idea that there is a wave of investors that have no allocations to the precious metals that are going to be given a reason to be interested. And that's where I think stock market volatility for the Western investor is the trigger for the next wave of growth in gold and silver. Won't surprise me to see gold trade over $5,000 an ounce. Won't surprise me to see silver trade over $150 an ounce. Is that a 3 to 5 year time frame? Probably. It's a pretty remarkable setup. We have a price insensitive buyer in the gold market in the form of central banks.
Mm-hmm.
They're allocating reserves out of dollars and out of treasuries. Frankly, they don't like working with the US anymore,
right,
whether it's their trade policies or looking at the dollar and seeing it as a less stable asset than it has been previously. I think certainly it factors in when they look at the shenanigans currently happening with the Federal Reserve. A part of the legitimacy of the dollar is how the people who are managing the currency are viewed. And if they're trusted, if that independence factor is there, then the dollar is a better asset to have. If, on the other hand, the Federal Reserve is called into question in terms of its integrity, and I'm
looks like we've got a minor glitch in David's feed right now. Oh, he's back. Okay, go ahead.
Yeah, so if they're doing a good job managing currency stability, there's no reason to make a move. So far, we've seen in the last 20 years a significant increase in allocation to euros. And this year, central banks have allocated in aggregate more to gold even than to euros. So the preference is for hard and tangible asset with trust factor with a group of PhDs managing currency. That's really intriguing that some of the smartest central bankers in the world are basically saying, yeah, we'll take the gold. Right. We don't need your stinking dollars. We don't need your stinking euro. That price insensitive buyer puts something of a floor under the gold market. Now the question is there a value differential between gold and silver where we think silver catches up to gold? And is there any catalyst that drives gold higher and still allows for an even bigger catalyst for the catch up in silver? And I think that's what we're looking at is an unwind in equities in the US is something that we think is going to be hard to avoid and would be a great catalyst for a move higher in the metals. But the other thing, I mean, if I was going to look at two things, set equities aside, I think gold and the migration to gold, the two most important variables I would be looking at is what we talked about earlier, the spread between short-term and long-term treasuries, where again, if the Fed funds rate gets collapsed because you can stack the board and make it happen, that's what Trump's trying to do. The bond market, if the long bond starts to yield and that difference between short-term and long-term borrowing expands out, you've got problems in the equity market. You've got big problems in the equity market because at the same time you've got duration changing in price, you are also going to have credit quality changing in price too. We have the tightest spreads between junk bonds and treasuries that we've had in 28 years. That's crazy. Nobody thinks that there's any risk that they need to be added, compensation for by buying a junk bond.
Right.
You buy a treasury, you buy a junk bond. I think investment grades are currently like 73 basis points more than a treasury. You're not being compensated for the added risk that you're taking. So you see spreads change. That's one thing to keep an eye on, and that will be a catalyst for a movement to gold. I think the other thing is just watch the dollar. Yeah. U.S. dollar relative to the euro index. We're at about 97 right now. And, breaking these levels, we've got room to move to 90 next. Your next major support is 80. And then beyond that, it's the 2008 lows in the low 70s. So it's not out of the realm of possibility over the next 18 to 24 months, we see the dollar trade 25% lower than its current levels. I don't care what happens in the equity market. If the dollar's taking in the shorts, this is why it becomes a catalyst for equity market selling, because you've got the highest percentage of foreign ownership in U.S. equities ever. And if they brought foreign capital into the U.S. market, thinking that the dollar is stable and we're buying the best economy in the world, what happens if the dollar is no longer stable? You get a 25% return in your equity portfolio, but the dollar's down 25%. You took the risk for nothing.
That's right.
Does that make sense? Or if you get a 20% drawdown in equities and a 10% drawdown in the currency, that's a 30% loss to your foreign investors. We've got $11.5 trillion invested in U.S. equities from overseas sources, relative to $9 trillion in the U.S. bond market. There's now more in equities than there is in bonds. That's never happened before.
Right.
So you begin to see pressure in the U.S. dollar. That will translate into flight capital being repatriated and going other places, where it came from elsewhere in the world. I think watch the long bond and the short short rate and the long rate. That's certainly something to keep an eye on. And watch the dollar value.
Well, you just gave us a mini economics lesson right there in a short period of time. But you're so good at taking the complex and breaking it down to really signals that we can look at as individual investors. And these are the kind of conversations that we love to have with you and our other service providers that do such a great job. David, go ahead.
I want to say one thing real quick. That when we went through the April period where stocks are selling off, the thesis that we have for hard assets was playing out very well. The differentiated performance, where we're up in the first quarter almost 10%, while the equity markets are down 10 to 15. And then as they've recovered, we've just gained more as the year's gone on. Hard assets have a really unique place, and I'm not saying that a hard asset portfolio is all weather, in the sense that over the course of 100 years, these are the things that you need to own. I'm saying that in a period of time where inflation and rising interest rates are the norm or become the norm, that's a period where hard assets outperform. That can be oil and gas assets. We love pipelines. We love a lot of things within the infrastructure space tied to energy. All of this stuff is publicly traded. We probably have 40, 50 stocks in our portfolio. Precious metals, miners. First quarter of 2024, they were making $650 per ounce profit margin. By the first quarter of 25, they were making $1,300 an ounce profit margin. By the end of the second quarter, they're making $1,750 an ounce profit margin. That's an average across the entire industry. They have the ability to leverage, and their share prices do too, a move in the metals. So if you have a 1x move in your insurance component, what we do on the asset management side, specifically in that subsector we manage in precious metals mining shares, we're seeing 2 to 3 times moves there. So it's again, this is not something you just sort of set and forget for the next 20 years. This is a unique period of time, and would love the opportunity as the years progress to continue to share our thinking about how a portfolio needs to migrate to reflect the environment you're in. This is the portfolio for this environment. As the environment shifts, you have to shift with it.
Couldn't agree more. David, what's the best way for people to connect with you and the McAlvany team?
Yep, McAlvany.com is the easiest entry point. And at McAlvany.com, you can find our weekly commentary. You can find a host of resources. If you're interested in the hard asset strategies, we have something that we publish every Saturday, Hard Asset Insights. And of course, I do the commentary Wednesdays. If you're interested in precious metals and figuring out how to have that strategy applied as sort of a complement or a sleeve to the other things that you're doing, Jeff, you probably know Jeff's email better than I do. I have to
not off the top of my head, but we can grab it and put it in the notes. We'll do that. We'll toss it in.
Great.
Well, David, thanks so much for being here today. Always a wealth of information, and I know people if they connect with you on any basis, they'll learn a lot. So, Thank you much. Look forward to seeing you in the near future.
Thank you. Appreciate the invite today.